All right, welcome everybody. So we've got lots coming up as we always do. On the 24th of August at 6:30 p.m. We're going to have a special webinar with Alicia Barnett. Alicia is our go-to person for long-term care solutions. So we know that about 70% of retirees are going to need long-term care sometime in their lifetime. It's an important issue that we have to address, and it's not always that easy. And I'll tell you, in my opinion, there is just not one thing that's going to save you if you need long-term care. It's going to be a combination of your own savings, an insurance policy that you may have or may not have. Hopefully you do. If you have traditional long-term care insurance, if you use the long-term care benefits that are tied to some life insurance policies, it's going to be a combination of many things. It is really easy to have all of your assets drawn down using or needing long-term care for just one person, certainly for both. If you're married, going into retirement. So it's important to have this conversation and see what's available out there. And of course, we're working on our advanced class series. I hope to have that locked down this week. As far as when that we're going to do an on-demand seminar. So it's not going to be scheduled. It's just going to be sent out to you and you watch it whenever you'd like. We're going to see how that goes and see if it works better for you. But they're the two things coming up. I mentioned last week, but I have to say it again because I'm very proud of it. So I was awarded the Attleboro the 5-star Wealth Manager Award again, and for 2022. I was just learned that last week, so that's 10 years in a row. So I'm happy about that, and that really has to do with the success of my staff and really the comments from clients. So that's very, very helpful. I appreciate everyone for that. Today, for our planning section, we're going to talk about backdoor Roth contributions. So I've recently had some questions about this. It's a pretty simple process, but it gets a lot of confusion out there. And it's been in the news a bit because there's some legislation that may affect this capability. It's sometimes worth it, sometimes not worth it. It just depends on your situation. But looking at the headlines, I carry the Consumer Price Index as a headline every week until the next one. And as you know, all items increased 9.1% last month. So we'll be seeing that again shortly, what the update is. Hopefully it starts declining, but we've got a long way to go, folks, to go from 9% way down to where we should be, which is about 3.5% probably. So today in the Slott updates, we're going to keep it simple. We're going to talk about direct transfers, direct rollovers, and 60-day rollovers. So I really like this. This came out yesterday from Andy Ives, and I'm going to share my screen in a moment. But I really like this because we talk about these terms, and it's really fun for me because I hear from clients and people who are on these webinars regularly that you're really understanding this now. The importance of direct transfers, how to get things done, how to calculate Roth conversions, just really the nuances and why it's so important to pay attention to these things. So this ongoing education is just so vitally important. And I find that the folks who are really engaged and listen to these webinars are probably going to be the ones that are going to be most successful with these strategies. So good for you for staying on top of it. So I want to share my screen here and we'll walk through this together. And this was a recommendation from one of our regulars, Kathy, who said, there's so much information on these Slott updates. It would be helpful if we could read along with you. So I'm hoping that you're seeing my, I'm hoping you're seeing my notes right now. I see this running. So raise your hand for me if you see direct transfers, direct rollovers, and 60-day rollovers. All right, great. Thank you. So Andy writes, and we're just going to go over this today because I went through the mailbag and it was really kind of one-off kind of stuff. And I didn't think it would be interesting to most people. So we're going to just do this one piece today. It's pretty long though. But Andy writes, when moving retirement money from an IRA to IRA or from a workplace retirement plan like a 401k to an IRA, there are essentially 3 methods to relocate those dollars. 2 of them are similar, and the third one opens up all kinds of potential problems. Knowing how to properly move retirement dollars is imperative to produce the desired outcome. So I'm in this paragraph here, and I'm coming down here. And again, these might seem really basic and really simple, but these get messed up all the time by really intelligent and really well-meaning individuals. So it's important to, first of all, know what you're doing, but most importantly, I think just leave it to the experts, because, you know, we do this all the time. We're specially trained in these areas, and we're not going to mess it up. So direct transfer. First is a direct transfer. Direct transfer is the recommended way to move money from one IRA to another. With a direct transfer, also called a trustee to trustee transfer, the funds go directly from one IRA custodian to another. Note that if a check is made payable to the new custodian for the benefit of the account owner, but received by the IRA owner, that will still qualify as a direct transfer. So he goes on to list an example here, but a really common one is fidelity. So fidelity, like, why can't I say fidelity today? is the largest not sponsor, but custodian for 401ks. So the Fidelity will not send a 401k rollover check to our office. They'll send it to the client, and then the client has to deliver it to the office. Some companies will. So some 401k providers will. They'll send a check directly to us, made payable for the benefit of the IRA owner. But Fidelity, as example, will not. So, but that doesn't matter. The client still receives the check. It is payable to the, in our case, Charles Schwab custodian for the benefit of the client. And since it's made out to the custodian, it is a direct transfer, a trustee to trustee transfer. So even though you received the check, you can't deposit that check. It can only be, like your bank account. You can only deposit to your IRA. So don't let that fact that you're actually holding that check confuse you. So Andy writes, John has an IRA with custodian X. He wants to consolidate his accounts with custodian Z. John requests a direct transfer from his IRA to custodian X to custodian Z. John is a bit of a control freak and wants to make sure the transfer is completed. So he asks for the transfer check be mailed to him. And it's not always about that. As I said, some custodians just won't send it directly to the new one. Custodian X issues a check made payables to custodian Z for the benefit of John IRA. This qualifies as direct transfer, and John hand delivers the check to custodian Z. So that's what I just explained in a little more confusing way. Sorry, Andy. Direct transfers are not reportable to the IRS. As such, no 1099-R is created for the transaction. Additionally, if an IRA owner is subject to required minimum distributions, the entire account, including the RMD, can be directly transferred. There is no need to take an RMD prior to a direct transfer, although it must still be taken by the normal deadline. This all depends custodian by custodian. I've seen custodians that force out that RMD before a rollover or a direct transfer. Direct rollover, when retirement dollars move from, I'm obviously right here, just bringing it to where we are. When retirement dollars move from a work plan like a 401k to an IRA, the best option is a direct rollover. So now I just forget about Fidelity for a second. That would actually be a direct rollover, the Fidelity example. A direct rollover is similar to a direct transfer, but with a couple of differences. Primarily, a direct rollover is reportable to the IRS and will generate a 1099-R showing the distribution. When the direct rollover is received by the IRA custodian, the custodian will produce a 5498. So 1099-R is produced by the retirement plan. And then the 5498 offsets the retirement plan, or the rollover, excuse me. So the new custodian will generate the 5498. Confirming the rollover and eliminating any possible taxes due. In addition, if the plan participant is subject to RMDs, the RMD must be taken before the remaining funds are directly rolled over. Direct rollovers also avoid mandatory 20% withholding if plan dollars were paid directly to a plan participant. Note that there is no mandatory withholding on IRA to IRA transactions. So this is another area of confusion. Sometimes when you call in to get the information, and again, the larger companies are usually good, Fidelity, Vanguard, etc. But still sometimes you get that person on the other end of the phone that says, no, there has to be a 20% withholding. That's just not true with direct rollovers, direct transfers. Now, here's the one that gets people, the 60-day rollover. When an IRA owner or plan participant takes a distribution that is paid directly to him or her, he has 60 days to redeposit all or part of those dollars into the same or a similar account. Funds can move from plan to IRA and IRA to IRA via 60-day rollover. However, this type of transaction opens numerous opportunities for error. We talked about this with the private letter ruling a week ago. There's some self-certifications for messing up 60-day rollovers. This is how often it happens that the IRS came back and said, we're going to have this list of self-certifications because this is so common, and these private letter rulings can cost, $10,000, $15,000 for the taxpayer. And it's the most common private letter ruling is messing up a 60-day rollover. Such distributions from a plan require 20% withholding, and any RMDs included in distribution cannot be redeposited. Also, a person is only permitted one IRA to IRA 60-day rollover per 365-day period. That's the 1 per year rule. Note that non-spouse beneficiaries cannot do a 60-day rollover with inherited accounts. Inherited IRAs and work plan assets must be moved by either direct transfer or direct rollover. That mistake is also made very, very often. I famously tell a story about an attorney who did exactly that and made an entire, I think it was a $2 million IRA taxable in 1 year. So avoid the 60-day rollover. Don't try to get creative with funding the purchase of a house, a boat, or something like that with your IRA dollars. It's better to handle it another way. Be sure to understand these methods before requesting any retirement account transaction. All right, I hope that was helpful. Some basics there. We're going to go on and talk about investments, but let's see here. We've got a question. Doug says, it's not clear why the direct rollover is better than a direct transfer when transferring a 401k to an IRA. So a 401k to an IRA is a direct rollover. A direct transfer, a trustee to trustee transfer is if you're transferring, say, from Vanguard, not retirement plan, to Charles Schwab IRA. So you have a Vanguard IRA and a Charles Schwab IRA, and you transfer directly. Now, in practice, what usually happens is what they call an ACAT, ACAT. I can't remember what the acronym is off the top of my head, but it's an electronic transfer that happens between firms. But it is possible to liquidate funds at Vanguard and deposit them into, for example, Charles Schwab and, for example, Vanguard. So that is a trustee to trustee or direct transfer. Direct rollover is coming from a retirement plan into an IRA. Hope that answers your question, though. Clearing this question. Okay. So now let's talk about the market. So this information this week, folks, comes from Franklin Templeton because both Invesco and First Trust, who are usually my go-to update information, they must be on extended vacation because they were not in my mailbox nor were responding yesterday. So last week, as the week ending 7/22, it's all greens. It's good to see for a bit. The S&P 500 was up 2.5%. The Dow Jones Industrial Average was up 2%. The Nasdaq was up 3.33. Russell 2000 3.59, and this just lists foreign stocks 4.43, very general, and emerging markets, so smaller economies, 3%. But the year to date, everything is still red. Year to date, 16.2 for the Dow Jones, or excuse me, the S&P. Year to date, 11% for the Nasdaq, and year to date, 11% for the Dow Jones, and the Nasdaq is down 24%. So still a very, very challenging year, and most difficult are the bond markets. So the bonds, the 10-year Treasury is down 9.7%. Globally, U.S. bonds, just generally U.S. bonds are down 8.7%. So, this is where most people have their frustration. As you heard me say, they have their funds being more conservative. I'm using air quotes, and putting them in the bonds as they get older, and they're finding that their bond holdings are down sometimes just as much as their stock holdings. So very challenging time, and brace yourself, because I think it's going to be some time, as I said, and that sometime being, we could really be in this murk for 1.5 to 3 years. So 1.5 to 5 years. It depends on how long inflation stays high, how aggressive the Fed has to get, how consistent the Fed is. I'm a little concerned that it might get choppy, kind of on again, off again. I would not want to be a member of the Fed through this at all. It's very, very difficult. But that said, article from the Wall Street Journal reads, after the Federal Reserve lifts its benchmark interest rate on Wednesday, attention will turn to what Chairman Powell says about a rate increase at the central bank's meeting in September. So tomorrow, we're expected to have another Fed funds rate hike of 0.75%. So that'll take us to a range of 2.25 to 2.5. While further rates are likely this year, Mr. Powell might be less specific about his expectation for their sizes, according to analysts. So where do we go from here, right? We're expecting a 0.75 tomorrow. Mortgage rates are already creeping up. So one of the folks I was with on Sunday morning riding to the shore from Center City was my nephew by marriage, who's a realtor, and he was talking about mortgage rates and where they are, and they're nearly double from where they are, in some cases double from where they were last year. So that's certainly an effect from these rising interest rates, but we're not seeing any dampening yet on the inflation rates. And this is the other article that I pulled out of the Wall Street Journal that I had this direct connection with from the weekend. But hotels are struggling to find enough workers to keep properties running smoothly as they ride a surge in pent-up demand for leisure travel. So, we had the employment market kind of empty out or really come down, especially in the hotel and restaurant industry. And now everybody's rushing back to travel. And in our case, it was really interesting to see just really a bare bones staff at the hotel. So as they ride a surge of pent-up demand for leisure travel, hundreds of thousands of hotel workers have left the industry since this pandemic, and many hotel operators are finding that higher pay and expanded benefits aren't enough to get people to sign on and stay. Some properties are cutting services or looking at technology to bridge the labor shortfall. So I'm interested, if you want to send me input about what you're seeing around there as you travel, as you're doing different things, that I'm always interested to hear that. BlackRock says expect more volatility after a Fed hike. So market views of Fed rate hikes have swung sharply. They say we see more volatility ahead as long as central banks think they can curb inflation without crushing growth. Yields spike. So treasury yields, bond yields spiked before the European Central Bank raised by 0.5% last week. We expect it to pause hikes, it being the European Central Bank, before the Fed as the energy crisis hits growth hard. And then BlackRock says markets, again, now this is their reporting in the first two sections. Now this is their opinion. Markets are pricing in another 0.75% rate rise in the Fed this week. We think the Fed will over-tighten rates and cause acute damage to growth before pivoting. So they're saying the Fed's going to clamp down too hard, going to cause damage to the economy, and then they're going to have to come off of it. So that's exactly what we don't want, right? But it's I will say, in my opinion, the Fed has seemed a little capricious in their actions. So that may be what we see. I think we're going to be in this volatility. Hopefully not the big swings that we've been seeing. My hope is that we're at least near the bottom of the drawdown that we could see, but I think we'll bounce around probably this range for the next several years. So that is the difficult part, right? Is finding the things that are going to keep us moving, because when inflation's high, even at 3.5% inflation, you still need growth in your investments. We can't sit where you've heard me say we're sitting in a tremendous amount of cash right now, very, very fortunately, but we can't do this forever because we need growth in our investments. So we've got to be creative and find some things, and we got to use the basics of asset allocation, principal protection, account segmentation to get us there. And it's a tremendous amount of work. We all know that. Clients who have been through it know it. Certainly our staff knows it. It is not an easy thing to do, to set up that account segmentation. Certainly asset allocation is relatively easy. Computer models, just kind of push that together. Anybody can almost do that on their own. but the account segmentation is the workhorse of what gets us there. So again, Mr. DiLucia, I'm going to share my screen again because boy, this report is just another great one. Now I want to say I don't invest in Prudential at this point, and now it's Empower. So just raise your hand for me. Click the raise hand button if you can see my screen tracking the equity bear market. So I just want to share with you, these are the bullet points that I pulled out of this report. These are just the bullet points. And so you'll see several pages here, but I'm going to just read some to you and try not to drone on too much with it. But I'm just always impressed with this man's thoughts and writing. I don't always agree, so Robert DiLucia, equity bear markets always reflect economic conditions to a greater or lesser extent, depending on the cycle. However, the current cycle is unique in several respects. The current bear market was triggered by factors internal to the equity market, primarily psychological rather than external economic factors. I'm sorry these dropped down a bit, but that's just how they formatted it. I'm sharing my notes with you, so I didn't expect. I really didn't expect to, but. So he's saying that the factors were more, and I thought this was interesting, psychological rather than really external economic factors. And my concern is then, well, we've got plenty of economic pressures hitting us now. If the psychological effect drove us down, how hard is the climb out going to be? And this is again why I believe that we're likely in that span of 1.5 to 5 years of some volatile and troubling times. Again, I'm hopeful for growth. I'm hopeful that we come out of this, but we had to prepare for, we come out of it quickly and in a normal cycle, 1.5 to 3 years kind of thing. But I think this one might be extended for a few reasons I've shared with you, and I'll touch on again as we climb through this information. So statistically, the nearly 25% decline in the S&P 500 was a result of shrinking valuations rather than failed earnings. Wall Street analysts' forecasts for corporate earnings have actually risen since the beginning of the year. So again, he's saying it's just the basic valuations of what people are willing to pay for positions rather than earnings. And he writes here, my central investment thesis is that the bear market is primarily an unwinding of the excess liquidity and valuations that propelled the previous bull market. Excess liquidity was the result of unprecedented amount of money injected into the financial system by the Federal Reserve in response to the pandemic. And I will say even before that. So of course we pushed a ton of money out into, trillions of dollars. I think the total in the end was over $9 trillion. So that all comes out into the economy and everyone is flush with money. I've heard story after story of people who got PPP loans and didn't use it. They didn't need it. And it's not a good situation. But even before that, decade and a half before that, really since 2008, 2009, interest rates were kept very, very low. We continued on these, times of quantitative easing where the federal government is issuing bonds and then buying those bonds back. And that just keeps money out into the system. Every time the Fed tried to raise interest rates, the market would work against them, press against them, and they would reduce interest rates again. So we had this long period of time of really just this support from the federal government for the markets and the economy that everybody was afraid to mess with. And this is what happens with the effects in Washington. So just like legislators don't want to mess with Social Security and Medicare until it's going to become crisis time in 2028 or 2030, nobody really wants to mess with interest rates until it's crisis mode. So here we are, crisis mode, and we're at this huge inflation number. Now the Fed has to step in, and I know people say the Fed is not political, but they live in Washington, right? And so of course it's political. They're all appointed positions. Of course they're political. So I'm not going to go through and read all of these. It reflects back to 1970s, I think the 1980s, and even into the 60s, if I recall. But I have one more highlighted section. So he writes here, I examined 10 cyclical bear markets dating back to 1965, with cumulative declines ranging from 20% to 57%. I'm right here. In all 10 instances, stock prices were higher by more than 23% one year. The median 12-month rally after, right, was 38%, while the average was 45%. So that's all great. And we take that information and we say, okay, looking back to the 10 bear markets that we've had going back to 1965, that seems a reasonable period of time. There's been, of course, some changes in how the Fed operates during that time and whatnot. But he's saying, you know, the 12-month rally after, you know, when we hit that bottom, he refers in previous notes to the bottom and really the bottom and the peak of the inflation number seem to be connected. So peak inflation, the bottom of the market drop. Then he's saying the average return was 45% in the 12-month rally following that. What's different this time is the millions of baby boomers who are retiring, right? All as we move throughout every week, every day, you know, there's 70 million baby boomers who are entering or already entered retirement. So what we have this drawdown of Social Security and Medicare that we've never had before. And we have this reduction of income into and in tax, right, into the revenue stream. So there are still plenty of baby boomers and folks we work with that are paying more taxes now, so they don't have to pay taxes later, of course, but that's still a small percentage. Most people are coming off the payroll. They're very, very happy that they're paying very low or no tax right now, and they're not looking into the future, but that is something very different today that we didn't see in the past. So this is why I have that concern about the length of time and the severity of the drop. So again, we may be near the bottom. I'm hopeful that we're near the bottom of the market drops, but we could see another 10, 20%. But I think it's going to be much longer this time, as you know, because we've got baby boomers by the millions who are just retiring, and this continues for several years. Okay, so let me stop sharing my screen before I forget. So again, I always have this defensively optimistic highlighted on here. We have to be defensive, but we also have to be optimistic. We want to build that foundation so that we can. You've heard me use the analogy of the buildings in San Francisco that can sustain an earthquake and hopefully still stand, have some damage, but still stand. You know, that's what I think about when we're developing portfolios, and I think everyone will agree who is working with us that we've done a good job of that so far this year. I don't think there's been a single client that we've had to take liquidate positions for a loss for funding of their retirement, which is really, I'm very pleased with. All right, so today we're going to talk about backdoor Roth contributions. Let me pull up my whiteboard here. I got some weird choppiness going on here. There we go. All right. Share my screen again. All right, so today, backdoor Roth contributions. So many people have heard of this. I get asked about it maybe, you know, half a dozen times throughout the year. So let's talk about what this is. So this is when you cannot make a contribution because you earn too much money. So I'll share here. Let me pull down the Attleboro Wealth Management website. There are these charts that are available to everyone. You go to the home page and then over to the slot corner here. And as you scroll down from the top of the slot corner, where we have all that great information about Ed. And I'm going to see Ed in October. We have to go out to Las Vegas. Well, it sounds exciting, but I don't want to go to Vegas for our training. But you can scroll down here and you can see these are the 2022 retirement plan contribution limits. So there are contribution limits for IRAs and back down here for Roth IRAs. So we're not talking about 401ks right now. We're talking about IRAs. These are what you can contribute in IRA or Roth IRA. So you can see for 2022, it's $6,000 until you're over 50 years old, or you reach 50 years old, I should say. And then you can contribute another $1,000. So that's $7,000. So now if you're working and you earn at least that much, you can contribute into a Roth IRA. And if you're married and even if your spouse doesn't work, then you can contribute another $6,000 or $7,000, depending on your spouse's age, into a Roth IRA. Except the IRS says, unless you make too much money. So what's too much money? So we have these Roth IRA phase out limits. In 2022, the phase outs start at $2,000 and $4,000 of modified adjusted gross income. I think that's modified. It might be AGI, but it really doesn't matter. I think it is modified adjusted gross income. $2,000 and $4,000, $2,200 and $4,000 to $214,000 is the phase out for married and the filing joint, and $129,000 to $144,000 is the phase out for a single or head of household. So what does phase out mean? Well, there's simply a percentage that you can contribute of that $6,000 or $7,000 while you're in this range. And then after you're over $214,000, you can't contribute anything into a Roth IRA. Same for single or head of household. So what do you do? Many people say, okay, well, geez, I can't contribute. But then they read about these backdoor Roth contributions. And a backdoor Roth contribution is simply contributing money into a traditional IRA. And let me go back to this deductibility levels. Here is the phase out ranges for IRA. Now, traditional IRA deductibility. So they're saying you can't put money into a Roth IRA. The IRS doesn't say that you can't put money into a traditional IRA. You just can't deduct the amount that you put in. So they'll allow you to put $6,000 or $7,000 into a traditional IRA, even if you earn more than $129,000 for a married filing joint couple, your modified adjusted gross income, or $68,000, $78,000 if you're single or head of household. So let's go to the married column. Your adjusted gross income or modified adjusted gross income is $129,001. You can no longer contribute or take a deduction for your traditional IRA, but you can put the money into the IRA still. So now you have after-tax money in your IRA. So but let's say you're actually $215,000 and you can't contribute to the Roth. You can't take a deduction for your IRA contribution, but as you saw, the IRS still allows you to put money into the traditional IRA. Well, currently under current legislation, you can move that money right to a Roth IRA via conversion. So don't forget, we're talking about, I'm going to move this down so I can write on it. We're talking about contribution versus conversion. So we're talking about contribution here. Let's just assume we're all over 50 and we're using that $7,000 number. So that's the amount that you can contribute into an IRA or a traditional IRA or a Roth IRA, but you've got to pay attention to the income limits. A conversion, we know that you can do as much or as little, right? You can do $1,000 or less. You can contribute as little, right? I guess you could do $1. So let's just say to 1 million or plus, so there's no minimum, there's no maximum that you can do a conversion. And there's no income limitations. There's just none. The conversion method is the best gift that the IRS and the federal government has ever given us, because there's no restrictions right now. There used to be, but they lifted them. So again, you could do as little or as much as you like. And it's a gift. Contributions are very tightly regulated. So what you do is, with the backdoor, here's your traditional IRA. And here's your Roth IRA. You put the $7,000 into here, or $6,000 if you're under 50. And then using the backdoor method, you immediately, so that's a contribution. Don't get a deduction. You can't get a deduction. You make too much money. You can't get a deduction. And then you immediately convert that money to the Roth IRA. So contribution, conversion. So now the $7,000 sits in the Roth IRA. Ideally, you don't get a deduction for this $7,000. This comes out of your savings, cash, stocks, whatever. So you don't get a deduction. You move it right over. Now you don't pay any tax on that conversion because this is after tax money. I hope that makes sense so far. So that sounds really simple, doesn't it? Yeah. Except for there is a thing called the pro rata rule. So the pro rata rule is where most people get stuck with this and why it doesn't work for many people. So let me see where we are. Make sure I'm all right. We talked about this. So let me just stay with this. So the pro rata rule, this sounds really simple and easy, $7,000. Hey, and I could do that. If I have a spouse, I could do it times 2. Now I've moved $14,000 into this. I don't know what happened there. Let's close that. No, I don't want to hit reload because I'm afraid we're going to, it's just click, raise your hand for me if you're seeing my whiteboard. Okay. Okay. Thank you, everybody. So the pro rata rule simply says, well, this all sounds great, but the problem is if you have money already in your traditional IRA, you can't, well, you can convert $7,000 into this, but the IRS is going to calculate what the percentage is of this $7,000 to what your balance is in your IRA. And that's the only amount that you're going to have to, or that you're going to be able to convert tax-free. So let me break this down and tell you what I mean by that. Let's just say, let's carry these buckets down. So this is traditional IRA. And this is Roth IRA. Now, if you have no money in your traditional IRA, this can work well, right? You deposit $7,000, you immediately convert it over, and there's no tax due. But now let's say we have $100,000 to make the math simple in a traditional IRA. Now you've read about this backdoor Roth conversion, or Roth contribution, excuse me, and you make a $7,000 after tax contribution into your IRA because you can do that. And you say, I read how this works. I'm going to now immediately convert $7,000 over to this Roth IRA, and I won't have to pay any tax on that because it's after tax money. And then you go through your year and you've done this tricky backdoor Roth conversion, and now it's time to do your taxes, and your CPA either tells you, oops, something happened, or worse, you go through a few years of doing this and the IRS comes back to you and says, you owe us some tax money. Because the pro rata rule says, well, if you're converting $7,000, we're not going to let you just identify this $7,000 as conversion. We look at the entire thing, and very simply, we'll take that $7,000, we'll divide it by the $100,000. So that is clearly 7%, and only 7% of this $7,000 that you've converted is entitled to be converted without additional tax. So that is $7,000 times 7% is $490. So $490 of this transfers over. You don't pay tax on it. But the remaining, what is that, $6,510, you owe tax on the conversion. Now, what's left then is you now owe, this is good, you transfer that over. Now this is still here, and if you decide to keep it there, you're going to owe tax on $6,510. And then you've got after-tax money here in your traditional IRA that you're going to have to keep track of. So if you want to do a series of conversions, you're going to have to keep track of how much of it is taxable and how much of it is tax-free. So it's a bit of a paperwork nightmare. There's forms you have to file, of course, forms 8606 when you do this, and you should be filing these when you do Roth conversions to help keep track. But what happens is that most people don't, and you end up paying tax on that money twice. So it's pay attention to the pro rata rule and what the effect is. This is if you have money in a traditional IRA. If you don't have any money already in a traditional IRA, then it can all work well. So it's when you make too much money to be able to contribute to a Roth IRA, you can contribute a non-deductible traditional IRA and immediately convert it. But you have to pay attention to the pro rata rule. This jams people up all the time. And then you have to, well, you can't recharacterize a conversion anymore. So you're stuck with it and you have to deal with the repercussions of it. So I have a question here. Let's see. Bill, can I put the $7,000 with a different bank to avoid the pro rata, i.e. have $100,000 in Vanguard, but put the $7,000 in Fidelity? Great question. I appreciate you saying that. No, the IRS looks at the aggregate. It doesn't matter. So what Bill's asking is, what if I have two or more traditional IRAs, right? So traditional IRA 1 and traditional IRA 2. What if I have, two of those, or some people have several? Can I kind of game this in the IRS? This one has the 100,000 in it. This one has 0. I'll just fund this one at $7,000 and convert that to a Roth. And I win, right? I won't have to pay zero. You won't have to pay tax on that. Now the IRS it gets that, and they get reporting from each one of your custodians every year of how much money you have in traditional IRAs. So they know that trick, Bill. And even if you got away with it for a year or two, you're going to get snagged on it because they're going to see, you're going to see what this is. So the requirement is on you, of course, to properly calculate this, and the pro rata rule is very, very clear. You have to aggregate all IRAs. So good question. Now, one thing you could do is Ed Slott refers to this as a reverse rollover. So say if you have $100,000 in an IRA, right, a traditional IRA, and you want to do this backdoor Roth conversion, and you have also a 401k that accepts rollovers from IRAs, well, you could roll that money into your 401k. Now that money sits here in your 401k, your traditional IRA has $0 in it, not percent dollars. That does not count towards a pro rata rule. There's a wall there. So for the IRS, it does not count for the pro rata rule. So that's one way you can get around it. For most people, it's not that meaningful, right? $7,000 a year, $14,000 a year. But if you can do it, you can. What I don't have time to get into, and we could talk about another time, is the mega backdoor Roth, and that is that refers to retirement plans. So I believe this year it's up to $58,000 or $53,000 a year if you're allowed to do after-tax contributions to your 401k. So this is after you've maxed out your 401k earnings, and let's just say you don't have a Roth option, or maybe you do and you just want to put more money in there. You can do after-tax contributions to a 401k if your company allows you for non-hardship in-service withdrawals, which simply means that you're over 59 and a half and you can take distributions from your retirement plan without any kind of penalties or anything like that. The IRS says you can. Some companies are more restrictive, but you could then roll that to an IRA, convert the entire thing to a Roth IRA. Of course, you still have the pro rata rule requirements, but that can really move the needle for you when you can get that much money moved in. Great question, Bill. Thank you. The last part I have on here is pending legislation. Yes, there is pending legislation to eliminate the backdoor Roth IRA, which is really surprising to me. The IRS has said it's a fine process. Over many years, they've said that they acknowledge it and they say it's legitimate. You could do this. But I think it was the Build Back Better plan that obviously didn't make it through all the way, but they wanted to eliminate the backdoor Roth IRA, which again surprises me because you've got to pay tax on the contribution. But I guess as I'm thinking through it, it's allowing more money to go into tax-free and build tax-free without any immediate tax benefit if done right to the federal government. So I guess it does make sense. All right, folks, that is it for today. It's 10:49. It was good seeing you all. We'll see you next week. If you have any questions, reach out to us. if if there's any comments or contributions you want to make, I'm always open to it. And we'll see you next week's webinar and the special webinars coming up. Take care. Have a great week. Bye.